Right, let's get started. Welcome everyone. Thanks for attending today's webinar. We hope you find the information really useful. We will be featuring a Q&A at the end. So if you have any questions around Lawpath, I'll be your go-to. Anything in regards to today's topic on tax and asset protection, Tim will be asking throughout and at the end. But even if you guys want to follow up with us afterwards, you absolutely can for demos, for your questions, if you want to understand your business structure or your existing trust or looking to do a trust, we'll be more than happy to have a conversation with you. So today we're looking at how trusts can maximize tax benefits and asset protection. And before we go through it, just a quick thing about Lawpath. If you are new to us, we get people coming through to us for a litany of different reasons or different sources. The primary one being we are Australia's largest incorporator of new companies. And in terms of not only just our subscriptions, but also just the businesses we've registered from ABNs, the ACNs, the trusts we've set up. We've now assisted over 500,000 businesses in the last 10 years that we've been operating, and well on track to hit our target of 1 billion businesses by 2030. Hi, Marina. Welcome. Thanks for attending. Also within that time frame, we've saved in terms of legal fees over 500 million. And you may have caught us perhaps in the news or come to our recent client event here in Surrey Hill, Sydney. But we've also partnered and been invested with by Westpac. And all we do fundamentally, if I was to boil it down, is to take any of your complex legal or accounting issues and make them simple, easily fixable, and at all times just provide you guys with a proactive approach to your businesses. So you're not chasing your tail, you're not having to react to things as and when they come up. So today's agenda, I'll be introducing Tim again soon, but Tim will be covering quite broadly different types of trusts, the advantages and disadvantages of running your business through a trust, and finally, a multitude of different tax considerations. And as I mentioned, we will finish with how Lawpath can help, so just taking it that step further, and a Q&A at the end. And if you're new to Tim Quinn, he's our head of tax and accounting at our Lawpath Tax and Advisory. He's a very, very senior chartered accountant. I'd recommend anyone checking out like his LinkedIn profile, for example, and seeing the litany of accolades and experience that he has. But shock horror, he's an expert in accounting, in business structures, in tax planning, budgeting, financial accounting, all that you can see there. And I believe his favorite topic, funnily enough, is trusts. Nothing gets him more excited than talking about trust structures. So whatever you've come to today to listen to, whether it's on the topics or maybe we haven't covered something, maybe there was a key piece of information you really wanted to learn, do let us know and ask us towards the end. Awesome. So I'll control the slides, but I'll hand things over to you, Tim. Thank you.
Thank you very much, Connor. And he's dead on. Trusts are my favorite topic to talk about. And someone's already asked, just want to make sure that you're all muted. Yes, all participants are muted. So don't worry, you can yell at the screen all you want. We won't be able to hear you. Just before we do kick off my favorite topic, which is trusts, let's just do a brief nod to the budget the other day. Not going to be too exciting for you, I'm afraid. The tax relief was modest. It's what Peter Costello was pillared for as a milkshake and a sandwich tax cut. It's not a big deal, but it's always welcome. Small businesses and small taxpayers love a bit of savings, even if they're not massive. I would say my main takeaway is, for those of you, and not of you on the call, of course, but some of you have got friends maybe who have just let their tax obligations slide. The ATO is a toothless tiger. It's just going to give you a slap on the wrist. Be prepared to have your world rocked. The ATO's compliance activities have been boosted already. They've just got a budget kick in to hire some more people to come after the smaller end of town as well as the top end of town. So don't think that you're going to skate by unnoticed. Also, on our side of things, we accountants, we're going to get a closer look at by our tax practitioners board. There are some cowboys out there. Think twice when you're getting maybe the cheapest accounting services provided, and know that quality doesn't always come with that. In terms of trust, look, no substantive changes. There is a particularly famous case in front of the courts, well, soon to be in front of the courts again. It's just left. So if anyone knows, if Stephen Bendel is on this webinar, please make yourself heard. He's an accountant whose own trust is in front of the courts, and it's interesting. Look, that's an edge case. Trusts are and remain and will always be the single best tax planning opportunity for Australian small businesses. Why do you, the audience, think that trusts are allowed to keep getting by with these great tax savings? This is a bit, if anyone wants to jump in, there's a Q&A function, or you can chuck it in the chat if you prefer. I'll give you a clue as to why I think trusts still exist and why trusts are still so tax effective. And I'll give you the clue being, when I was a younger man, I used to know that the cheapest pint of beer in Sydney available was in the members bar of New South Wales Parliament. And that was because it took an act of legislation to change the bar prices in the New South Wales Parliament. And it was not in anyone's self-interest to raise the price of beer in their own bar. So if anyone feels like jumping in as to why they think family trusts are still so tax effective, even though they do come up in the news as being a bit on the nose sometimes, I'll give you the answer. It is because about 2/3 of federal parliamentarians have a family trust. These are not crazy out there structures. We're not dealing with Liechtenstein or British Virgin Island registrations. We're not dealing with really complex, risky tax structures. Family trust structures are straightforward, they are legitimate, and they have fantastic tax savings. So without further ado, we might jump into the substantive bit of talking about trusts. What is a trust? Look, I'm not a lawyer, but I know a little bit. I'm what you sometimes call a bush lawyer. I'm an accountant with a law degree, so I know enough to get myself into trouble. When you're setting out to start your business, there are a few ways of doing it. You might have started as a sole trader. You might have decided at some point you want the protection of incorporation. Thoroughly recommend it. We love a company. You might be operating a business as a trust. You might have a family trust that owns a company. Very, very common. My favorite, but that's my golden structure is basically an operating company owned by a trust. Often you'll use a combination of these structures. What is a trust? Trust isn't actually a legal entity. It's often a confusing thing. A trust is not a thing. A trust is a relationship. A trust is a relationship between particular parties. The rules of that relationship are covered by a trust deed. You can think of your deed as being the rules of how it operates. The essential part of this relationship is a legal person, which is the trustee. And we all, of course, remember that a legal person can be a company. Companies are legal people. That trustee holds property for the benefit of others, as specified in the trust deed. So the trustee is the legal owner of a thing, whatever that thing is. It has full legal rights over the control of that asset, of that thing, but it doesn't own it for its own benefit. It owns it for the benefit of others. So although, as I've mentioned, it's not a separate legal entity, tax law does treat them as an entity for tax purposes. So a family trust will lodge a tax return as if it is an entity, despite it just being a relationship. That comes from Bamford, a very, very famous case. Just to answer a few questions while Connor's moving the slides across. Yes, Andrew, I'm with you. Those few cowboys do give us a bad name. I love a bit of tax practitioners board compliance. It makes the rest of us stand out in the market for doing the right thing. Mohammed has said, can we please get the slides? Yes, they will be sent out to all participants. And I'm happy just to keep answering questions as and when they come through. We might talk a little bit later about PSI rules. Thanks for that, Maru. And then we've had another question. As a SaaS startup, can we raise funds from investors and VCs if we operate under a trust? What I would recommend there is a structure where you have your operating company, your holding company, which is where you attract outside investment, and then the bit of the holding company that you own that as a trust. So I wouldn't recommend operating as a trust. I would recommend a trust that owns your little bit of the holding company. Moving swiftly on, the parties that we're talking about in this trust relationship, a lot of them drop off and aren't that important from an accounting perspective and a tax perspective. The settlor and the appointor are very important in setting up the trust, and important where there's disputes and changes to trustees being made. The most two important parties from a tax perspective are the trustee. So it's that legal person, company or individual that legally owns the thing, the asset that is generating income. And then it's the beneficiaries who get the benefit of the thing. That is the essential relationship moving forward that gives us access to all of the tax savings, and of course the asset protection reasons as well. Fiduciary duties are very, very important. Again, hashtag not a lawyer, but we know a little bit. The fiduciary obligation says that when you're a trustee, you don't do anything for your benefit. It is all for the benefit. It is undivided loyalty. It is this Beach Petroleum and Kennedy case. It's been settled trust law for centuries, I would say, that basically you don't look after your own interests as a trustee. You look after your beneficiaries' interests. So you must act in their best interest when you manage a trust, not your own. Now, in your bog standard family trust, where mum and dad might be the directors of the corporate trustee, they might also be the beneficiaries. Who cares? You're all the same legal, natural person at the end of the day. But there are, of course, edge cases where that is very important, where there is a separation between those people. So your duties there are to act in good faith, not to act in conflict, not to profit as the trustee, and that you can't delegate your duties to someone else. You can't just park your obligations and let someone else take care of it. Look, what are the remedies for breaching that duty? There's account of profits, there's compensation. It all basically means the same things. In equity rules, you can be basically told to put right whatever you've done wrong. There is a broad power of remedy when it comes to trusts, and you can certainly rescind contracts as well. And the question has come through, can we book a one-on-one consultation to look at that structure? Absolutely, we'll be in touch with you there. And the difference in small business CGT concessions between trading company owned by the old trading trust. Trading trusts you used to see a lot of, increasingly less, I'd say. You don't see many trading trusts these days. Ultimately, small business CGT concessions are available. It becomes there's an extra hurdle to jump when you've got a company owned by a trust as opposed to directly through a trust. There's a 20% rule. It's all very doable. So I would say not a huge substantive change, but do check with your accountants. A special purpose vehicle for project development, we have to raise capital. Again, can't give advice without knowing more than that, Emma, but I would say a structure, you often see unit trusts in combination with family trusts, in operation with holding companies and operating companies. When you're doing project developments, there's usually a strong legal imperative to have a separation of ownership there. I'd certainly involve a level of trust within that structure. We've got a really, really simple example of a trust here that we see every day at Lawpath, and that every accountant that is involved in this area will see. ABC Pty Limited is a company, but it is a trustee company. So it's had an appointor, Anthony, who we then promptly forget about for a tax purpose. But there is a sole director and shareholder, I'm assuming, Robert. That company, all it does, it has sole purpose of owning the business, or operating the business, pardon me, Joe's Fruits, which is actually XYZ. The beneficiaries of this trust are Robert, who we already know wears a different hat, and we have a charitable beneficiary as well, which is possible, and we have a third beneficiary, Globex. I dare say that's going to be called what we call a bucket company, or a corporate beneficiary. Beneficiaries to trusts don't just have to be natural people, they can be legal people. So it's kind of a very simple trust. You'll often see a similar structure where Joe's Fruits would be Joe's Fruits Pty Limited. and the trust would own that business. It's probably even a more common scenario. We've got some questions coming in. You've set up a company whose shareholder is a family trust. Yes, that's a very, very common structure with a company where the shareholder is a family trust. That is my golden scenario. Hybrid trust structures, yes, more complex area, but trusts can have a mix of fixed and discretionary components beyond the scope of today, but we're happy to talk to about it. Can the appointer also be the director? That's a legal question. I don't want to step on our lovely lawyers' toes, so I won't answer it. You do typically see that they're not. I'm assuming there's a good legal reason for that. And then just while we're loading up the next, I'm running an Airbnb business, want to save tax. Is trust good? Yeah, we'll get to that. Trusts are good for running most businesses. I'd definitely recommend having a look. A trust and a company is a legal entity. It has shareholders. A trust is different. A trust is a relationship, probably beyond the scope of today. They're very different, actually. Another question, can a trustee company do separate businesses? It can. A trustee company doesn't just have to be a trustee. I would strongly recommend that you don't do that. I would strongly recommend that you keep a trustee company just to be a trustee for the reason that we've already talked about, those fiduciary obligations. Don't muddy the waters. Don't have a situation where you're not quite sure what a trustee's obligation is. We always recommend just separation. I know it's an extra company, you've got to pay an extra rego fee, but it's worth it. Geez, we've got a lot of questions coming through. Fantastic. I'll deal with what I can very quickly. Best time to start a trust is today. You can only benefit from tax savings once they're up and running. So get going. I'd say before the start of the financial year is particularly important for a reason we'll come to. Is setting up a trust expensive? No. I wouldn't deign to give you an exact quote, but it can be in certainly the low thousands. When we come to an example, you'll see that the tax savings from that will often outstrip the cost in year one. So we'll move on. What's the right trust for you? These are the two main types of trust. I just mentioned hybrid trust. It's somewhere in between. A discretionary trust is where the trustee has discretion between the beneficiaries. There might be 4 potential beneficiaries. Me, put on my trustee hat, I decide who's going to get the income or the property from that trust at my absolute discretion. Fantastic. I love the power. I get to decide, and I might know how much tax those people are already paying, how much income they're already earning. I might get to decide, well, so-and-so is earning a low salary. Maybe I'll give them more income this year. You can see the tax planning opportunities are already whirring in my head. There are no limits in that discretion as long as it's covered under the deed. It's often something we as accountants are told, check the deed, but as long as it's allowable in the deed, you can do what you want. Beneficiaries, they might get the benefits, that they do not get to legally influence the decision. Interesting. That is absolute discretion. We often see these for small family businesses. They're fantastic for asset protection and tax purposes. Unit trusts are a little bit of a different beast. Yeah, a unit trust feels more similar to a company. So for whoever asked before, what's the difference? A unit trust, it has sort of elements of a company about it. You will be issued a certain number of units that will entitle you to a certain fixed proportion of the income and the capital from that trust. The trustee still exists and still manages and operates and distributes, but it distributes, if a certain party has 20% of the units, they get 20% of the stuff. So that's pretty straightforward. Unit holders will exercise directors' control and will have decision making, but it depends on their proportionate ownership. As I mentioned before, very, very popular for investment and for property in particular. Thank you, Connor. And while you do that, we'll look at the advantages and disadvantages. The questions are coming thick and fast. The use of a bare trust structure and land tax. Let's book a consultation to talk about that. It's very, very complicated. Worth a longer chat. And then the last question that's come through. If I currently run a business as a PTY Limited and want to convert into a family trust with the present company as the trustee, the tax implications, yes. So For a start, I wouldn't advise using the present company as the trustee. I would recommend selling your operating company from yourself to a new family trust and having a new trustee. The tax obligations, there might be capital gains tax implications, but there are concessions available for small businesses to roll this over and have no immediate taxing point. So I'd love to chat with you more about that, Maru. Amy has asked, can units of a unit trust be transferred, bought and sold? Yes, subject to the deed, subject to the rules. So often there will be a clause in there that will allow you to transfer units in your unit trust. All right, we'll get quickly moving through the advantages of a trust. They are many. Asset protection is first and foremost, and there's a reason why we deal with this before tax. The asset protection comes about where you're separating legal ownership from beneficial. This separation, if it feels artificial to you, you're not the first person to wonder this, but this separation means that you can effectively shield assets from creditors. So if you're operating a particularly risky area of business, which many small businesses are, you might not think it, you'll be operating, putting yourself at legal risk with lots of businesses. Trust can be used in a way that if you are carrying on a business that is risky and that it gets sued, that business actually has no attackable assets, or it's very difficult to attack the assets because the assets, legal ownership has been separated. They might, throughout whatever structure we put in place, it's a very effective shield. So that's why we like them. We also like them because of tax minimization purposes. It is a natural side effect. It is a natural consequence of this asset protection that we get this ability to put on the hat at the end of the year and say, who's going to get what? Who's going to cop the tax consequences? It allows us to distribute income to people that can deal with it in a much more tax-friendly manner. Tax minimization is never the point of a trust. It is never the dominant purpose, because to do so would be running afoul of Part 4A, which says in our Tax Act that if you're just doing something for the purpose of a tax benefit, they don't want to know you. It is just a happy consequence of the asset protection purpose. We've talked to death about flexibility and how much value that is. It is a huge advantage. It's also great structure for succession planning, although perhaps not a Murdoch-style trust, which has been picked apart over a little bit in the United States. Very, very complicated structure. But yeah, it is a great way of building family generational wealth, and having corporate trustees where you can transfer upon the death of one family member and have the next generation take over. It's a great vehicle for doing so. Disadvantages. Maybe we should just skip that. No, we shouldn't skip that slide. Of course, there are disadvantages. There are setup costs. As you imagine, as you get more complex, it's more expensive to set up. Sole trade is easy. You can go out and get an ABN through Lawpath for next to nothing. You can do your own tax return for next to nothing. It's a very cheap way of doing things. As you get more tax benefits, it's more complex, it's more costly. So the setup costs in terms of actually getting the trust set up, you need a lawyer really to have a look at the trust deed, make sure that you're covered. You might need little bits of other. Some trusts will have to have additional GST registrations, often not. If a trust is just owning a company, you probably don't need to register for GST. There are some complexities, of course. You're taking on the fiduciary duties as the director of a trustee company. You've got to take that seriously. You can't just let someone else take care of that duty. It is your duty. So there's a bit more complexity, a bit more ongoing cost as well, ongoing administration. Of course, it's a tax paying, or it's a tax declaring entity. It'll have to lodge a tax return. So there'll be some reporting off the back of that as well. Limited access to capital. Someone already asked this. Is a trust a good vehicle to raise capital in? No, not really. But a trust that owns a holding company is a very effective vehicle for access to capital, and it's very, very common. But yes, more difficult to use assets held within a trust as collateral. Not impossible. You'll need a broker that really understands what's going on. Just as we cycle to the next one, Jeffrey, yeah, look, you're asking the more complicated tax trust issues here. UPEs, Part 100A, in terms of disadvantages. It really comes down to the distribution of income there. If you are doing a straightforward distribution of income to yourself, to your partner, to adult children, where you are actually transferring the cash along with the profits, to a corporate beneficiary, to a bucket where you are actually transferring the cash and you are actually paying tax, I would say those things don't even come into play. But often the use of trust is more complex, and these rules about unpaid present entitlements do come in. And that's why, of course, you retain a very good accountant who knows what they're talking about and can advise you there. Another question just about selling a PTY Limited. I have an LLC. Oh, goodness me. Can you sell it to an Australian trustee? Look, a trustee can own anything. It can own shares certainly in a Delaware C Corp, in an LLC. I'm not an American accountant. I couldn't tell you the answer. I have to beg off that one. I apologize. Let's look to some more legal and tax considerations. There's a lot there. I won't read it out, everything. But of course, you don't go into these things blind. You treat it seriously. They are very tax effective, but you don't jump into them without having thought about it and without having hired a lawyer who's thought about it for you. Think about the type of trust. Think about the rules that you put in terms of your deed. Check off what sort of liabilities are you exposing yourself to, and are there additional protections you need? Do you understand that you're going to need to lodge a tax return? Have you thought about the costs of doing that? Look, do you actually have people available? You might be, if you're flying solo and you're already earning a fantastic income and you've got no one to distribute income to other than yourself, don't bother with a trust. Arguably, if a tax consideration is important, you can only give it to yourself. It really becomes more useful when you've got parties that you can distribute to. Think about how you select your beneficiaries or your class of beneficiaries. Often just family members seems straightforward. Think about family members and perhaps their marriage circumstances, for those of you that don't approve of your children's partners. There are trusts out there for you as well, testamentary trusts, way beyond the scope of today. Select who's going to be your trustee. Not a simple, straightforward question. If you're a married couple, do you both want to be directors of the trustee company? Probably. Makes sense. Does just one of you want to do it? Potentially fraud. Do think about it and do talk to your lawyer about that. We've got just a couple of questions while they're doing that. You can transfer, you can sell a house that you currently own to a trust. That's no problem. Think twice about it though, particularly if it is your primary place of residence and you are therefore effectively having a tax-free asset because you own it personally. I'd think very carefully before transferring it into a trust. Talk to your accountant. John has asked, can a family trust make distributions to a religious organization? It's not a DGR, but it is potentially self-reporting as self-assessing as exempt from income tax. That's a complicated one, John. I would hate to answer it for you in a webinar without knowing all the background. Disadvantage, are the losses trapped within a trust? Very true. You can't distribute losses within a trust. So what basically happens if you have a loss in a trust, much the same as in a company, to be honest. So in a company, you can't issue a negative dividend. As a trust cannot distribute a loss, what you can do is you can use that loss to offset future gains. And so you can reduce your future profit distributions. Davina has just asked, is there a tax cut for, I don't know what that word is. Is there a tax cut for trusts? The tax savings come about from having that flexibility to select beneficiaries who have lower tax rates. So a trust itself, ideally, if you're distributing it properly, doesn't pay any tax at all. It just decides who gets that income. So that's really the basis for generating that income. All right, let's move on. How do you set one up? First of all, just talk to a lawyer. Let them walk you through it. Don't try and do it all yourself. It's complicated. These are the 5 steps. They're straightforward for a lawyer. They're complicated for you. Lawpath Legal sets these things up every day. and they know what to look out for. It's very, very hard to fix errors in a trust. One slip of the pen, you dot your I, cross your T wrong, you have to go back and redo it. It's not worth it. Get it done right the first time. Thanks, Connor. How do we reduce tax? We touched on this a few times. Let's get to the nitty gritty. Everyone makes fun of me because I start moving my hand around when I'm talking about trusts. What I'm doing is I'm putting on hats. I was saying to one of my colleagues earlier, I feel like you should go into your kids' dress-up box and get a cowboy hat and a fireman's hat, because it can get confusing. But when you put on your trustee hat, that's the trustee that it has a sort of an unbreakable oath that it has to act in the beneficiary's best interest, but it has absolute discretion within those beneficiaries. So as you're running up to 30th of June, you gather around your potential beneficiaries, you find out how much income they've made that year. That decides, or that may decide, where you decide in your absolute discretion where to send some taxable profits. Because as you'd imagine, someone that's already on a 47% marginal tax rate, there's not much point sending them $100,000 of profits because you'll be paying that straight to the ATO. If someone has $5,000 of taxable income, you would love to throw them some distribution because they will pay much lower tax. The first $20,000, of course, is tax-free for everyone. So you might be in a great scenario where you pay no tax at all on the profits coming through tax. The second benefit of that is not just access to more tax rates or more tax buckets, more tax-free thresholds, is this idea of the tax holiday. When you're paying salaries, you're effectively taxed there and then. There's money withheld from salaries straight away, and you pay that straight to the ATO. It's gone. If you're putting a scenario in place where you're paying profits in the form of dividends from a company up into a trust, you're then sitting down on deciding on 30th of June who gets it. You're reporting on that on the 15th of May, as late as you possibly can the next year. Someone who's mentioned UPEs and directors' loans off the form of this, Jeffrey would be familiar with the idea that then the clock starts ticking. Maybe there is an interest charged on day one on that loan. Maybe you've got effectively another 10 months to actually do anything and pay these things off. What it basically means is that a good accountant will pay tax later than you otherwise would. So you hopefully reduce your tax and you also hopefully pay it later. And you can use that money in the meantime. Do we have any more questions that have come through? Not in particular. If you're working, good question, if you're working and earning, does that go to the trust? No. If you're a salaried employee that can't control your source of income, if it's your income, it's your income. So this really helps small business owners rather than salaried employees. Good question. If there are no beneficiaries except yourself, Mark, is it still worth protecting your company with a trust? Yeah, it is. There's still genuine asset protection reasons for doing so, just obviously fewer tax reasons. Just very quickly, Andrew's asked, profits of the trust are distributed. Yeah, that's right. Yeah, oh dear. You definitely do not want to withhold. I can't imagine why any accounting firm would ever withhold $10 in profits. Don't know why you do that. A discretionary trust should always distribute all of its profits. So we always want to avoid the trustee being assessed. But that's a good point, Andrew. If the trust doesn't distribute its profits, then the trustee is taxed at prohibitive top marginal rate. No, we've already gone through that one. Let's move swiftly on. I've chucked myself, I think, as the working dad in this example. So Quinn Consulting, I've left Lawpath. It's been a nice time, but I want to cast my web further. Quinn Consulting is going to project to make $200,000 profit this year. Fantastic. We've done well. Quinn Consulting is also it's run by my wife as well. It's a bit of a family business. We've set up a structure through Lawpath. Quinn Consulting Pty Limited, the operating company, is owned by the Quinn Family Trust. And we've got, I don't know who Adam is, he's crept in. He's probably supposed to be Timothy. We've got 2 trustees. That can be personal trustees or corporate, doesn't matter. Most importantly, let's look at the Quinn family. Nicola is a working CEO. She's already earning $200,000 of salary. Nothing we can do about that. She's already on top marginal rates. So she's already earning, every dollar she earns above that is going to be 47% taxed. Myself, I'm a working dad. I've cut back my hours, enjoying time by myself to play Xbox, whatever it is. Um, Probably not taking care of my kids. They look pretty old from these photos, but I'm only earning $60,000 of salary. Here's some juicy beneficiaries for me. Joe and Lydia, our two adult kids. Joe's on a gap year. That means he's doing nothing. He's not studying, he's not working. Not so great for himself, but good for tax purposes. Lydia's doing uni. She's got a bit of a bar job. She's earning a little bit of cash, but again, not very much. Let's flow through this practical example. Where are we going to send this $200,000? I'm sure some of you have already got some ideas. As we move to the next slide, Joy has asked, do beneficiaries have to be over 18? Yes, they do. It used to be you could chuck everyone a big whopping distribution. Children under 18 now will have a prohibitive tax rate, so it's not worth doing. There's a tiny amount, 200 odd dollars that you can give them. It's not worth it. Just give it all to over 18 beneficiaries. I will leave some of those questions and come back to them. Let's go back to this practical example. A couple of easy, straightforward options. That company, Quinn Consulting, has got this $200,000 in profit. You could easily just pay it to Nicola. Director's fee, 47%, you pay $94,000 of tax. Simple, straightforward, although I have also forgotten to mention that you'd have to pay super on that, super on director's fees. So there's a bit going on in that option. Option B, let's pay this as a dividend up into the family trust. The trustee, again, putting on the cowboy hat, fireman's hat, put on the hat of trustee. Trustee has absolute discretion. Trustee looks around and says, I'm going to give $40,000 to Lydia. She'll only pay an extra $5,000 of tax on that. I'm going to give $40,000 to Joe, who's having a year off. You'll only pay $3,000 on that, on $40,000 of income, $3,000 tax. There's still 120 left over. I'm a working dad. I'm only on 60. I can cop it. It'll only take me up to $180,000. I'll pay $42,000. Now you add all that up, the family is going to pay $50,000 of tax on that $200,000. We have just saved in year one of operation of this trust, $44,000. So if you're thinking, okay, it's going to cost me a few thousand to set it up, it's going to cost me a little bit in annual tax, compliance obligations. I'm going to have to sign a few more bits of paper as the trustee, but gee, I'd have just saved $44,000 in year one. Pretty good outcome. Pretty good indeed. The question Andrew's followed up, if an assessment's been issued, is the commissioner limited to going back a set number of years? Yeah, typically 4 years, unless there's been an instance of fraud, in which case that gets opened up a bit longer. If we're talking $10 and 47% of $10, they're probably not that bothered. I would suggest you aren't either. You probably pay it. If it's going to be material, yeah, you'd certainly want to engage an accountant if the commissioner was seeking to open up a material number of years. Yeah, absolutely look into that, Andrew. We've had another question about distributions. No, not to under 18s. Anosh, that looks like a complex one. We might reach out to you separately just to handle that. How does the trust reinvest? Very good question from Ludo there. The trust can't reinvest profits. The trust must distribute profits, but there is nothing to stop the trust distributing profits. Well, for a start, the operating company doesn't have to declare a dividend. So the operating company can retain profits and reinvest it there before pushing it up to the trust, before pushing it out. But if the company has pushed everything through and the trust distributes all of its income out, you can, of course, reinvest that money personally back into your business as an after-tax re-input back into your company. Very quickly look, bucket company. Yeah, they could have. That's a very good question. Bucket company would have saved more tax. The person who asked that question, I dare say you're thinking, why'd you give $120,000 to Tim? You could have given that to a bucket company. And we definitely look at that. When we do tax planning, we'd say, again, it's going to cost you another few $1,000s to set up this bucket company and keep it tax compliant. yeah, you could save more tax. The issue there is what happens to that money you've given to the bucket company. It's an advanced topic that I'd love to talk about you more. Is in this example, we can pay more to Joe. Yeah, you could give more to Joe. And if you were, just bear this in mind, the straightforward way is that you would have to give Joe more money, and maybe you're concerned that Joe won't spend that money wisely. What used to happen with family trusts is that you would put on paper that you would give Joe 80 instead of 40. And you'd just keep the money yourself. You'd put it into mum and dad's bank account. The ATO is frowning upon that these days. The reason why you typically see smaller distributions to adult children is either you're happy to actually give them that cash, or you can have what's called a reimbursement obligation where you've paid some expenses for them and they're happy to pay you back with a trust distribution that you keep. So that's why that distribution to Joe looks lower than the absolute tax best outcome. It's more of a practical real world example, which a couple of people have asked about. I'm glad some people are challenging me on this. There is a reason that I've done that. It's even though it's not necessarily the absolute optimum tax outcome. Back to Connor. He's going to talk to you more about how Lawpath can help with these issues that have come about.
Awesome. Thanks, Tim, and thanks everyone for your questions so far. We've still got just shy of, well, just under 20 minutes left on the webinar, so keep them coming in as they come up. Quick piece from me then on how Lawpath can help. I hope everyone can appreciate, obviously, try to show you at least the basic description of trusts, how they can help, the advantages and disadvantages. But if you guys have been monitoring the chat and the Q&A, you can see there are still a lot of nuances, for lack of a better word. A lot of things going on within your own businesses or your own setups, which are just specific to you. So it definitely pays, if you guys do want to have a chat with us after the webinar, definitely get in touch. You can call in or respond to the email we'll send out with the webinar slides, and we can go from there. So quick, I'll skip through this and how Lawpath can help, but in a nutshell, heaps of contracts, we've got workflows, we've got the legal consultations and accounting consultations. And we do have a lot of documents actually in regards to trusts that you guys can access. It's what a lot of the accountants who are currently use us when they're on our basic essentials plan will come and grab these documents from us, as they're fully customizable and have been drafted already by a commercial lawyer. And there's a few examples there for when you're actually just searching things in relation to trusts. So just quickly talk about our legal plan. So there's our essentials. It's basically us providing you with the bare minimum of legal documents. We've got something over 540 now, as I said, already pre-drafted by a team of lawyers, fully customizable. There's even a lot of AI and software tools built in where you can ask it questions, get it to draft your additional provisions and clauses based on your business. It can review, it can simplify text, translate, offer suggestions and insights. There's heaps and heaps of things available in there to make your life easier when you do just want to quickly grab a document and get it sorted in 5 to 15 minutes, depending on complexity. There are, as you'll probably see there as well, the ability to add additional team members. We have an e-sign built in, so same concept as DocuSign. And we've just gone live, I think today and tomorrow. We've actually built out even further the collaboration aspects of the platform. So if you are working with, say, your co-founders, your HR rep, anyone who might be involved in the business, and you're looking at a document, you can now do that together in real time. So then it's the legal advice plan. So this is actually the most popular. We've shot ourselves in the foot there, putting it on the essentials. The legal advice plan is the most popular. It includes everything in the essentials, but now you have the added benefit of the 30-minute legal consultations with our legal team, as well as the live chat, as well as the unlimited on-call legal contract reviews. You might notice at the bottom there of the ticks, there's discounted fixed price quotes on contract drafting, but this also stems out to additional legal work you may need us to do. So Tim's mentioned at a few times that especially when it comes to trusts, you do actually want to be speaking to a lawyer or our legal team. Our legal team are the guys who actually set up the trusts. And this would be one of those things that would actually fall within that bracket of an additional piece of legal work. And for that, you would actually get a discounted fixed price quote for that if you're on our legal advice plan there as well. So if this is something you want to get set up, or maybe you have the trust already and just want to talk to our lawyers or accountants and have it kind of reviewed or maybe reorganize it, this would be a good fit for you. And yeah, I should go explain a bit about the accounting plans. There is also two sides of the same coin. We have an accounting advice plan as well. So unlimited consultations with our accountants, same concept, this kind of quotes for additional work. And we have a separate tax compliance. So this will be all that hands-on work. The only real difference here is that it just depends on how many interactions you'd want to have with the accountants. The tax plan does include an initial consultation and an end of fiscal year one, as well as all those hands-on work like your BAS, your financial statements, business tax return, all that good stuff. We can do a personal tax return as well for an additional cost for those people who do tend to ask us for that as well. Where you might, be checking with the business more around like your accounting software, your bookkeeping, tax minimization strategies, it pays to actually combine those two together, or even include it with the legal as well if you're setting up that trust. Most of you, if you haven't spoken to a lawyer in the last 6 to 12 months or at all, will have additional needs more than just your trust. So it might be your IP, your employment, debt recovery, your business structure, including like your ABNs and ACNs. The list goes on. There's a lot we deal with and help with on that front. And if you did want to combine those all together, we have this on our website. We put all discounts already up there on Lawpath. If you did want to combine all three, what we call our business success bundle, we do provide a 40% discount on there to get the unlimited consultations with both. Our lawyers and accountants literally sit next to each other, so there is a lot of liaison going on with them. That could be about your trust, or it could be about something else where they can have that back and forth and provide you guys with the absolute best advice going forward. If anyone would want me to elaborate on that, I can run anyone through a quick product demo of the platform, like what our accounting and tax dashboard looks like, for example, how to do a document, or if you have more questions on the subscription, please just let us know. Just type in yes, or reach out to us, or respond to our emails later today. Sorry, guys, nearly there. So in line with this webinar, we do have the 40% off on the bundle, but if you just wanted to get the tax plan for your trust or other legal business entities, we do have 30% off on our tax plan, as well as a 20% discount code on our quarterly plan for the legal advice plan.